Welcome back to our channel, where we delve into the world of investments and help you make informed financial decisions. Today, we're diving into a topic that's often considered a cornerstone of conservative investing: bonds. In this video, we'll explore what bonds are, how they work, and why they can be a secure investment option. So, let's get started. Bonds are debt securities that are issued by governments, municipalities, and corporations. When you invest in a bond, you're essentially lending money to the issuer for a fixed period of time, with the promise of regular interest payments and the return of your principal investment at maturity. Bonds come in various types, including government bonds, municipal bonds, and corporate bonds. Each type has its own characteristics and risk profiles. Let's explore them in more detail. Government bonds are issued by national governments to finance public projects and manage their budgetary needs. They are often considered the least risky because they're backed by the full faith and credit of the government. This means that the chances of default are relatively low. Municipal bonds, on the other hand, are issued by state or local governments to fund infrastructure projects like schools, hospitals, and roads. They offer tax advantages in the form of tax-free interest income, making them attractive to investors in higher tax brackets. Corporate bonds are issued by corporations to raise capital for various purposes, such as expanding operations or refinancing debt. They generally offer higher interest rates than government or municipal bonds to compensate for the additional risk associated with investing in private entities. Now that we understand the basics of bonds, let's explore why they can be a secure investment option. One of the primary advantages of investing in bonds is their relative stability compared to other investment options. Bonds are often considered less volatile than stocks, which can experience significant price fluctuations. This makes them attractive to conservative investors seeking more stable returns. Another advantage of bonds is their predictable income stream. When you invest in a bond, you receive regular interest payments, usually semi-annually or annually, based on the coupon rate specified at the time of issuance. This consistent income can be particularly beneficial for retirees or those seeking steady cash flow. Furthermore, bonds offer a variety of maturities, ranging from short-term to long-term. This allows investors to align their investment horizon with their financial goals. If you have a specific time frame in mind, you can choose bonds with maturities that match your desired timeline. While bonds offer numerous advantages, it's essential to consider the potential risks and factors to make informed investment decisions. Firstly, bonds are subject to interest rate risk. When interest rates rise, the value of existing bonds may decrease because investors can find new bonds with higher yields. Conversely, when interest rates decline, the value of existing bonds may increase. Understanding the relationship between interest rates and bond prices is crucial for bond investors. Secondly, bonds are not immune to credit risk. This refers to the possibility of the issuer defaulting on its payment obligations. While government bonds are considered the least risky, corporate bonds carry a higher risk of default. It's important to evaluate the creditworthiness of the issuer before investing in a bond. Lastly, inflation can erode the purchasing power of bond returns over time. Since bond yields are typically fixed, if inflation rises, the real return on bonds may decrease. Consider the potential impact of inflation on your investment returns when incorporating bonds into your portfolio. Now that we've discussed the advantages and considerations of investing in bonds, let's explore some tips and strategies to make the most of your bond investments. 1. Diversification. Just like any investment, diversification is key. Spread your bond investments across different issuers, maturities, and types to reduce the risk associated with a single bond or bond type. 2. Bond laddering. Consider implementing a bond laddering strategy. This involves investing in bonds with staggered maturities to create a steady income stream while reducing the impact of interest rate fluctuations. 2. By reinvesting the proceeds from maturing bonds into new bonds, you can maintain a diversified portfolio. Research and due diligence. Before investing in bonds, conduct thorough research on the issuer's creditworthiness and financial health. 3. Look for ratings from credit rating agencies and review the issuer's financial statements to assess their ability to meet their payment obligations. And there you have it. We've explored the world of bonds, from their types and advantages to the potential risks and considerations. Bonds can be an excellent addition to a diversified investment portfolio, offering stability, predictable income, and various investment options. Remember, it's essential to understand the specific characteristics of the bonds you're considering and assess your risk tolerance and investment goals before making any investment decisions. If you found this video helpful and informative, please consider subscribing to our channel. By subscribing, you'll stay updated on our latest content covering investments, personal finance, and wealth management. Thank you for joining me today, and until next time, happy investing.